Small moves before December 31st can save you tens of thousands of dollars over the course of your retirement. As the year winds down, most retirees are focused on the holidays and on their family, not so much on their taxes and investments. But some of the most valuable tax-saving opportunities will disappear when the clock strikes midnight on December 31st. Whether you're retired or approaching retirement, there are strategic year-end moves that can lower your tax bill, reduce future required minimum distributions, and make your portfolio more efficient moving forward into the new year. In today's video, we're going to cover the best year-end tax moves for all retirees in 2025, from charitable giving and Roth conversions to tax loss harvesting and qualified charitable distributions. And before we dive into all that, my name is Ryan Knoll. I'm a certified financial planner and founder of NAV Wealth Partners, a financial planning firm where my team and I help clients nationwide make smart money decisions. Let's get started. So why does year-end tax planning matter? Once the clock hits January 1st, your tax year is locked in. You can't go back and make any adjustments. That's why November and December are critical for retirees. It's your last chance to control your 2025 taxable income, manage your required minimum distributions, and set up next year's tax strategy on your terms. The good news, though, is you don't have to overhaul your plan to make an impact. A few focused moves done before the end of the year can easily save you thousands of dollars in taxes over time. The first strategy I recommend is to do strategic Roth conversions before December 31st. If you're in a relatively low tax bracket this year, especially the 12 or the 22% bracket, a Roth conversion could be one of the smartest moves you make before the end of the year. A Roth conversion just means moving your money from your traditional IRA to your Roth IRA and paying taxes on the converted amount now. Once inside the Roth, your money will grow tax-free, and withdrawals are then tax-free during your retirement. And here's why that matters. Converting now lets you fill up lower tax brackets at today's rates, and it reduces the size of future required minimum distributions, which can lower taxes in your 70s and 80s. And here's a quick example to go over. If you and your spouse are taking out $80,000 in taxable income a year, you're still under the 12% bracket, which tops out around $97,000 for 2025. That means you can convert an additional $17,000 to Roth and pay only a 12% federal tax on, essentially buying future tax-free income at a discount. And it's really important to compare where your RMDs might push you tax-wise in the future. If you're staring in the face required minimum distributions that will take you into the 22% tax bracket if you don't convert those funds now, this move will literally save you 10% on taxes on that distribution. That's a roughly $1,700 per year tax savings by converting that amount now, just by maxing out that 12% tax bracket. The key here is that Roth conversions must be completed by December 31st to count for the current tax year. You cannot push them into later tax years as it'll fall into the next year's conversion and taxable income amount. The second year-end tax move we like here at NAV Wealth applies to those of you who are already taking your required minimum distributions. And if you are taking those distributions, a qualified charitable distribution is a powerful way to give strategically. A QCD, as it's known, is lets you transfer up to $108,000 per person per year directly from your IRA to a qualified charity. The amount counts towards your required minimum distribution and does not show up as taxable income. And here's why that matters for you. You get the full charitable benefit even if you don't itemize your deductions. Your lower taxable income means less Social Security taxation and fewer IRMA surcharges on Medicare, and it's one of the most efficient ways to give in general. Let's just go through a brief example now. Let's say your required minimum distribution amount is $70,000, but you only need to pull $50,000 into your needed cash flow for living expenses for the year. You can take that $20,000 difference and give it to the charity completely tax-free. And here's how that helps. That $20,000 you gave is completely tax-free. It does not apply to your IRMA surcharge when they're calculating that at the end of the year for the following year's payment on your Medicare payments. And it gives a little bit more meaning to the money that you are giving. But remember, this check needs to go directly from your IRA custodian to the charity before December 31st for it to be able to be used under the QCD rules. The next thing you should think about doing is harvesting tax losses or gains strategically inside of your taxable accounts. And tax loss harvesting isn't just for younger investors. Retirees can benefit just as much or if not more. If you have a taxable brokerage account and some investments are down for the year, you can sell them for a loss and use that loss to offset capital gains or up to $3,000 of ordinary income. Let's go through a brief example. Say you sold a mutual fund for a $10,000 gain earlier in the year. You can sell another holding that's down $10,000 to offset that gain completely, zeroing out your tax liability. Even if you don't have gains, harvesting losses still helps. You can use $3,000 to reduce ordinary income this year, and any extra loss carries forward indefinitely to offset future gains. And there's also a hidden bonus, and it's one of my favorite tax code cheats. It's something I call the pseudo Roth IRA. If your taxable income is less than $96,700, your long-term capital gains rate is 0% in 2025, meaning you can also realize gains intentionally harvesting them if you're under that threshold and reset your cost basis completely tax-free or take that money as income. And this is a great way after you've successfully completed your Roth conversions or in conjunction with them to provide yourself with tax-free income on capital gains. Just remember to account for all of your income sources first, things like Social Security, pensions, annuity incomes, dividends, and interest. Then subtract from that your standard or itemized deduction to get your taxable income number. If that number is less than $96,700, everything you did for the year from a capital gains standpoint is completely tax-free. The key is to completely do any of the sales and the reinvestment before the end of the year and avoid wash sales, which just basically means you're rebuying the same or identical or substantially identical security within 30 days of that sale. Something else to consider is bundling charitable giving for bigger deductions. After the 2017 Tax Cut and Jobs Act, the standard deduction is high enough that many retirees no longer itemize. But if you want to make charitable giving more tax efficient, consider bundling multiple years of donations into a single tax year. Here's an example. Instead of giving $10,000 every year for the next 3 years, bunch them all together in 1 year and give $30,000 in 1 year. That large gift may push your itemized deductions above the standard deduction threshold, letting you actually claim a tax benefit. And then the next 2 years, just take the standard deduction again. That'll give you the most bang for your buck. To simplify this process, use something called a donor advised fund. You get the full deduction this year when you fund it, but then you can distribute that to charities over time. This approach compared beautifully with the Roth conversion, which offsetting the added taxable income with charitable deductions. This approach is increasingly harder to hit, especially if you qualify for the enhanced senior deduction recently passed as part of the tax code. I have some clients over the age of 65 who are married and can expect a standard deduction of nearly $47,000 this year and expect that to last all the way through 2028. So don't become hyper-focused on increasing your itemized deductions if you don't need to. Simply give and still take advantage of the higher standard deduction over the next few years, as that happens to have the math work out better for you. Now you want to make sure you're checking your required minimum distributions and the beneficiaries on all of your accounts. If you're age 73 or older, you must take your required minimum distribution by December 31st unless it's your first year, in which case you can delay till April 1st of the following year. Missing the deadline, though, will trigger a 25% penalty on the amount you should have withdrawn. So if your RMD is $100,000 and you didn't take it, you're paying a $25,000 penalty to the IRS. So here's a couple key points to remember. If you have multiple IRAs, you can take the total RMD from any one IRA. You don't need to spread them out proportionally. For 401ks, though, each RMD must be taken separately. So if you have 2 old 401ks, one at a previous job and one at the job you just retired from, make sure you're taking the appropriate amount from each. You also need to know that qualified charitable distributions can count towards your required minimum distribution if executed properly. We did just go over that. So while you're reviewing your RMDs, though, it's also a good time to check your beneficiaries on all accounts. If life circumstances have changed because there's marriage, divorce, maybe a couple more grandkids came along the way, update them before the end of the year. It's one of the simplest but most often overlooked parts of your financial plan, and it'll help protect you should you pass away. Now, the 6th step is one of the most important ones in my mind, and that's reviewing your withholding and estimated tax payments. Many retirees are surprised by tax bills in April because they forgot that investment withdrawals, the required minimum distributions, and Social Security benefits don't automatically withhold enough taxes. So before December 31st, review your year-end income and tax payments. Ask yourself, have I withheld enough to avoid underpayment penalties? Do I need to make an estimated tax payment by January 15th? And should I adjust the IRA or pension withholdings before year end? One quick strategy I follow with clients if they feel like they haven't withheld enough is that you can actually make a Q4 IRA withdrawal with withholding in December to catch up on underpaid taxes for the whole year. The IRS treats withheld taxes if they were paid evenly throughout the course of the year, even if you make the payment all in December. So if you find yourself, say, looking at a $10,000 underfunded tax liability, take an IRA distribution in the amount of $10,000, withhold it all for taxes or as much as you can. Typically, it's like 99% of the distribution, and have that go to Uncle Sam so you don't get charged with an underpayment penalty. And you also don't want to forget to factor in your state taxes as well. In Pennsylvania, we pay a little bit over 3%. In California, though, it could be as high as 13%. That can literally cause a surprise 5-figure tax bill if you're not planning for it appropriately. So make sure you know your state rules. It can save you hundreds or thousands of dollars on IRS penalties in the future as well. Next, you want to strategically rebalance your portfolio and review your asset allocation. Year-end is the perfect time to rebalance your portfolio, selling appreciated stocks and adding the underweight areas to maintain your target allocation. This not only helps your portfolio stay aligned with your risk tolerance, but it also sets up better tax efficiency going into the next year. And here's how to make it tax smart. Rebalance inside your IRA and 401ks where trades don't trigger capital gains taxes, and then review your asset allocation. Put tax-efficient investments like index funds, ETFs, and stocks in your taxable accounts, and income-producing assets like bonds or real estate investment trusts in tax-deferred or Roth accounts. If you're holding appreciated stock, consider donating shares directly to charity or gifting to a loved one instead of cash. It avoids capital gains on your part and gives you the full deduction of the amount gifted. Rebalancing at year-end helps keep your portfolio on track while locking in tax-efficient moves before the calendar resets in the following year. Finally, let's talk about strategic gifting. For those of you who are potentially facing a taxable estate, make sure you're maximizing your gifts annually. You can give $19,000 to any person in 2025 and not have it count towards your lifetime exemption. You can also pay for someone's college expenses and not have the gift count as long as you give the money directly to the educational institution. So if you have kids or grandkids in college, this is a great way to reduce that financial burden. The idea here is to give as much as you're comfortable with while not adding to your taxable estate to save what is essentially a 40% tax on the amount over the $15 million lifetime exemption. If you're a married couple, that exemption doubles to $30 million in 2026. This is the largest tax surprise a high net worth person can face. So make sure you're utilizing a sound gifting and trust strategy each and every year to avoid what could potentially wipe out half of your estate over that exemption amount. Year-end tax planning is one of the most powerful and most often overlooked tools that retirees have. By acting before December 31st, you can not only lower this year's tax bill, you can reduce your future required minimum distributions and make your retirement income far more tax efficient. To recap, here are the 8 best moves again. First, strategic Roth conversions. Next, qualified charitable distributions. Third, tax loss and gain harvesting to make sure your taxable account is as efficient as possible. Fourth is charitable bunching and donor advised funds. Fifth, make sure you're keeping track of your required minimum distributions and beneficiary checkups along the way. I recommend no later than December 1st every year to have that set in stone. Sixth, withhold your estimated taxes so that way you don't have a surprise bill at the end of the year or an IRS penalty. Seventh, rebalance your asset allocation. And eighth, for your ultra high net worth couples and individuals, make sure you're maximizing your annual gifts every year. Each one alone can make a difference, but together I've found that they can create a tax-smart retirement strategy that compounds for years to come. If you want help building a year-end checklist tailored to your individual situation, that's exactly what my team does here at Navil Partners. We'll help you turn year-end tax planning into long-term savings. Thank you so much for watching, and as always, make smart money decisions.